Welcome back to the deep dive. So you've sent over some interesting materials today, it looks like, excerpts from ISA 520, all about analytical procedures in auditing.
That's right, ISA 520. It's a core standard for auditors.
Okay, and for listeners maybe not deep in the audit world, analytical procedures sounds a bit technical. What's the idea here? Like using comparisons to see if numbers make sense?
Yeah, that's a good starting point. Think of it as using smart comparisons, looking at trends, analyzing relationships and data, both financial and sometimes non-financial too.
Gotcha.
The goal is to see if anything stands out, if something just doesn't seem quite right based on what we know about the company and its environment.
So our mission for this deep dive is what? To kind of cut through the technical standard language and really get the essence of these procedures, why they matter.
Exactly. We'll pull out the core ideas from the materials you sent, the definition, why we do them, when we do them, what makes them work, give everyone a shortcut to understanding this key audit concept without getting totally lost in the weeds.
Perfect. Consider this the express route then. Okay, let's dive in. First things first. What are analytical procedures in, simple terms?
Well, the standard itself, in paragraph 4, defines them pretty clearly. It says they're evaluations of financial information through analysis of plausible relationships among both financial and non-financial data.
Plausible relationships. Okay, what does that mean practically?
It means relationships you'd reasonably expect to exist, like if a retailer's sales go up, you probably expect their cost of goods sold to go up too. That's plausible.
Right. Obvious connection.
Or maybe a factory increases production hours. You'd expect utility costs to rise. The definition also adds a crucial part: investigating fluctuations or relationships that don't fit, things inconsistent with other info, or way off from what you expected.
Okay, so it's like seeing your heating bill triple in the middle of summer. That's not plausible. You'd investigate that, right?
Precisely. That's the auditor's mindset. Find the anomaly, then figure out why it's there.
Can you give us some concrete examples? I think the materials you shared had some in the application section, A1, A2.
Yes, absolutely. Section A1 gives some good, common ones.
Yeah.
Comparing the company's financial info with its own prior periods, like looking at revenue this year versus last year.
Standard comparison.
Yeah. Or comparing actual results to budgets or forecasts the company made. Did they hit their targets? If not, why? Big deviation could mean something changed, good or bad.
Makes sense. What else?
Section A2 mentions studying relationships between different financial numbers that should follow a predictable pattern. Think gross profit margin. Sales minus cost of goods sold gives you gross profit. Right? Auditors often track that margin percentage over time. If it suddenly drops, maybe costs went up unexpectedly, or they had to slash prices, or potentially there's an error in how sales or inventory were recorded.
So you're looking for consistency within the company's own patterns.
Exactly. Internal consistency. But we also look externally. A1 also mentions comparing the company's numbers to industry data.
Benchmarking.
Right. Like comparing their ratio of sales to accounts receivable against competitors. Are they collecting cash slower or faster than average? Though you need to be careful comparing, say, a small startup to a huge corporation.
Needs to be a relevant comparison group.
Definitely. And A2 adds another angle, linking financial data to relevant non-financial data. The classic example is payroll costs compared to the number of employees.
Okay, yeah.
If payroll costs jump significantly, but the headcount hasn't really changed, well, that warrants a closer look. Could it be big bonuses or overtime or something else?
Something less legitimate, perhaps. Interesting. It really is like putting puzzle pieces together and seeing which ones don't quite fit. Okay, we get what they are. Now, why? Why are they so important in an audit? What's the objective?
Paragraph 3 lays out two main objectives for the auditor. First, it's about getting relevant and reliable audit evidence when we use these as substantive procedures.
Substantive meaning. Evidence gathering.
Yeah, procedures designed to detect material misstatements in the financial statements.
No.
So the analysis itself provides part of the evidence we need.
Okay. And the second objective?
The second one comes near the end of the audit. It's about designing and performing analytical procedures to help form an overall conclusion. Basically, a final check to see if the financial statements as a whole align with our understanding of the company we've built up during the audit.
Right, like a final sanity check before signing off. Does the big picture make sense?
Exactly that, a holistic view.
So they serve different purposes. When exactly do auditors use them? Is it just at the end or?
Oh no, they're used at various stages. We just mentioned using them as substantive procedures to get evidence.
Yeah.
And at the end for the overall conclusion. But they're also really important right at the beginning of the audit during the risk assessment phase.
Ah, okay. How so?
By doing some high-level analysis early on, looking at major trends, key ratios, we can identify areas that seem unusual or potentially riskier. That helps us focus our audit work where it's needed most. Pinpoint potential trouble spots from the get-go.
Smart. Focus the effort. Let's dig into those substantive analytical procedures mentioned in paragraph 5 a bit more. How do they actually provide evidence?
Right, so paragraph 5 defines them, again, evaluating financial info through clausible relationships. The supporting material, A4, adds that they can be very effective or efficient for certain assertions, certain claims management makes about the numbers.
Like whether revenue is complete or inventory is valued correctly, those kinds of assertions.
Exactly. For some assertions, analyzing relationships might give us better evidence or get us there faster than checking tons of individual transactions.
So it's a strategic choice. Use analysis when it's a better tool for that specific risk.
Precisely. Paragraph A6 makes that point. The auditor has to consider if the analytical procedure is suitable for the assertion, considering the assessed risk and what other tests, like tests of details on transactions, might achieve. It's all about tailoring the approach.
Okay, that makes sense. Now, what about the procedures at the end? The ones for the overall conclusion from paragraph 6. What's different about those?
Their main purpose, as paragraph 6 and A17 to A19 explain, isn't necessarily to find specific misstatements at that point, but to corroborate the conclusions we've already formed during the audit.
Corroborate.
Yeah, to confirm that the financial statements are consistent with our understanding of the entity. We step back, look at the whole picture painted by the final numbers, and ask, does this resonate with everything else we learned about this business this year? It helps catch any final inconsistencies or things that just don't add up.
Got it. The final, does this feel right?
Yeah.
Check.
Essentially, yes.
And if any of these procedures, beginning, middle, or end, flag something unusual, paragraph 7 talks about investigating, right?
Absolutely. That's crucial. If we find significant differences, fluctuations, or relationships that don't make sense or contradict other evidence, paragraph 7 says we must investigate.
What does that investigation look like?
Well, A20 and A21 give guidance. First step is usually inquiring of management. Ask them, why does this look unusual? Get their explanation.
Okay. But you don't just take their word for it.
No, definitely not. The next step is crucial. Obtain appropriate audit evidence relevant to their response. We need to corroborate what they tell us.
So, verify their explanation.
Yes. And depending on the situation and their response, we might need to perform other audit procedures, perhaps more detailed testing, to really get to the bottom of the difference. We can't just note an anomaly and move on. We have to understand it and its implications.
Right. Chase it down. So, we know what they are, why they're used, when they're used, but what makes an analytical procedure good, reliable, useful?
That's a really important question. Suitability and reliability are key. Paragraph A6 touches on suitability. Again, it depends on the assertion and the risk. Some relationships are just inherently more predictable and stable than others.
Okay, so predictability matters. What else affects reliability? The data itself must be important.
Hugely important. Paragraph A12 highlights several factors about the data we use. First, the source. Is it internal? External? Is the source itself reliable? Second, comparability. Are we comparing like with like? Comparing this year's data using one accounting policy to last year's using a different one might not be meaningful.
Right, apples and oranges.
Exactly. Third, the nature and relevance of the information. Is it the right kind of data for the comparison we're making? And fourth, critically, the controls over the preparation of the information.
Ah, the company's internal controls.
Yes. If the company has weak controls over how data is generated and recorded, then that data might be full of errors. Analyzing flawed data isn't going to give you reliable results. It's the classic garbage in, garbage out problem.
Makes total sense. You need a solid foundation. What about the auditor side? How precise do our expectations need to be when we do the analysis?
Good point. Paragraph A15 talks about this. The auditor needs to develop an expectation that's sufficiently precise to identify a potential misstatement that could actually be material.
So not just a vague guess.
Right. If your expectation is too broad, like sales should be somewhere between $1 million and $10 million, that's not going to help you spot a problematic $500,000 error. However, A15 also notes that the required precision can vary. If the underlying relationship is very strong and predictable, like, say, commission expense as a fixed percentage of sales, you might not need incredibly detailed data to form a pretty precise expectation.
Okay, so the stronger the expected link, maybe the less granular the data needs to be for a useful check.
That's often the case.
This is fascinating from an audit perspective, but how can someone listening connect this to, well, everyday life? Is this kind of thinking used outside of finance?
Well, absolutely. I mean, at its core, it's about pattern recognition and anomaly detection. We do this all the time, maybe without calling it analytical procedures.
Like how?
Think about your personal finances. You probably have a sense of your typical monthly spending on groceries, right?
Yeah, roughly.
If you suddenly see your grocery bill jump 50% one month, you'd notice. That's an identified fluctuation. Your next step is investigation. Why? Did I host a big dinner party? Did prices go way up? That's the same logic.
Huh. Never thought of it that way, but
Oh,
yeah.
or maybe you follow a sports team. You expect them to perform at a certain level based on past results and their players.
Hmm.
If they suddenly go on an unexpected losing streak, you start analyzing what changed, injuries, new strategy. Are they just playing poorly?
You're looking for explanations for the deviation from expectations.
Right. Or even tracking website visits if you run a small business online. Exactly. If traffic suddenly plummets or spikes unexpectedly, you don't just shrug. You dig into your analytics, try to figure out the cause a marketing campaign worked or failed. A technical issue. It's all about having an expectation, comparing reality to it, and investigating the differences. It's a fundamental critical thinking skill.
That's a great connection. It demystifies it a bit. It's about being observant and asking why when data doesn't match what you anticipate.
Precisely. A skill valuable way beyond just auditing.
Okay, so let's try and wrap this up. If we were to boil down the key takeaways from this deep dive into ISA 520 and analytical procedures, what would they be?
I'd say number one, analytical procedures are essentially about evaluating financial information by looking for and analyzing plausible relationships in data, both financial and non-financial.
Okay, look for the connections.
Number two, their main purpose is to identify things that seem unusual inconsistencies, significant fluctuations, unexpected relationships which might point to risks or actual misstatements.
Blot the anomalies.
Number three, they're used throughout the audit for risk assessment to start, gathering substantive evidence during, and for an overall review at the end. Different uses, same core technique.
Versatile tool.
And number four, their effectiveness really depends on things like the predictability of the relationship, the suitability for what you're testing, and crucially, the reliability of the underlying data. Garbage in, garbage out.
Need good data for good analysis. And it's fundamentally about that pattern recognition and asking why when things don't line up.
You got it. That's the essence.
Which leads to a final thought for everyone listening. Considering these methods, these ways of analyzing information and looking for patterns, what unexpected patterns might you start looking for in the data you encounter daily, whether it's personal, professional, or just observing the world? And what might those patterns reveal? Something to ponder.
Definitely food for thought.
This has been incredibly insightful. Thanks for breaking down ISA 520 for us. Really appreciate you guiding us through this deep dive.
My pleasure. It's an important topic.
Indeed. Well, until our next exploration, thanks for tuning in to the deep dive.